Hello, welcome to the FX Week Ahead with myself, Giles Coughlin, and we will be looking at what's going on for the next coming week. Just before we really get going, there's a quick look at the disclaimer that's just explaining that as we look at various scenarios and trading situations, just to remind you that this isn't trading advice. It's designed to educate you to see how a professional trader goes about trading, how they define and limit risk, and what kind of factors they're looking at. So just to make that clear before we get going. I'd also like to just ask if you could just let me know if you can hear me. Let's just see who we've got here. Hello again, Emily, Dion, Ravi, Gwenna, Salim, Van, good to have you here, guys. Hi, Alexander, you just joined us. That's super. Could someone just type in the questions and let me know? Thank you, Emily. That's great. You can hear me. I always feel peace of mind when I know you can hear me. I know I'm not speaking to myself. For this week ahead, we have got a really interesting week. There's so many different sort of factors going on, and the world economy is at a real crossroads. You could literally see it going either way, and so it's a really fascinating look ahead that we have, and a really fascinating week. So I'm looking forward to taking us all through it. Before we get sort of going, the event that was sort of widely anticipated was the release of a whole swathe of data out of China. It was Chinese industrial production, their retail sales, and their GDP figures. And just for your education, I thought this is a really good opportunity to kind of put it into context why the Chinese economy is such a big deal. It's not always obvious. It can take some time, but there's one sort of infograph that I came across that I thought would be really helpful for this time, and it's an infograph that breaks down the global economy by its GDP. So there's, the whole globe has a GDP, and what this infograph does is literally a breakdown where that proportion of global GDP is coming from. So, for example, nearly 1/4 of the entire globe's GDP comes from the United States of America. That is an enormous figure. And you can see that nearly 15% of the world's economy comes from China. So I hope this helps you to see that when we've been talking over these seminars about a US-China trade war and the implication that tariffs and the US and China have on each other, I hope this puts it in perspective, because 25 plus 15 is nearly 40%. So a trade war between China and US is going to weigh on global growth, because it's 40% of the entire global growth comes from these two nations alone. And that's really a phenomenal statistic. And I hope that helps you to see, well, hang on, this is why China has such a focus. This is why what's going on in China is weighing on global equities. That's what we saw in December. We saw a continued fall in the Standard & Poor 500, the US indices, and it just kept falling, and it was because of this concern. And the trade talks are currently ongoing. It's a thing to say that Donald Trump has been constantly giving out positive signals about the US and China trade dispute. So that's one thing to watch this week. And in particular, the focus of the dispute is about intellectual property rights. So the politics of the situation is that Donald Trump is really concerned about the S&P 500, and when it falls, he's been down on record as saying he considers that to be, a significant, a failure. He's measuring his success by the S&P 500. So he has to say that China and US are doing positive moves in resolving a trade dispute. However, the real issue is down to the intellectual property rights, and there hasn't been any headway made in this area yet. So in terms of a resolved dispute, look at the intellectual property rights. That's the key issue between China and the US at the moment. And tariffs are on a truce at the moment. But this factor is weighing on global economy, but the market has been sort of relieved recently. Okay, the focus that, as I started at the webinar, coming into Monday, was China's GDP and their industrial production figures. And there's been some concerns because China's GDP growth has been falling. And in fact, I think this quarter is the slowest quarter's growth for China since 1992. So that gives you some context of the slowdown in China's growth and why people who are focusing on China's growth can see the danger that a slowdown in China would be. And it's also worth noting that China is projected to be going on creating more and more of percentage of the global GDP. So China is becoming a greater and greater nation, and some people see China having the potential to outstrip the US as the largest GDP contributor to the globe. So I hope that gives you a little bit of context and helps you understand why, it's such a focus of the markets. So the GDP data came out for China, and it wasn't as bad as everyone expected. It was 6.4% year on year expected, released, versus 6.4% year on year expected. And for the full year, it was 6.6%. For the fourth quarter, it was 1.5%. So that was okay. Now, that again, a little bit of context. Some people are very suspicious of the data released from China. Some people question the validity and whether it's actually reliable. There are some questions regarding that. However, these were the latest data releases, and so in a sense, the market is slightly relieved. But as I said, that GDP data, it looks impressive, doesn't it? 6.4% year on year. You think, oh, that's fantastic growth, and it is growth. But yet, the fourth quarter growth of 1.5% is the slowest since 1992. So just to get the context, things are slowing down. The industrial production was 5.7%, and that was a strong beat, okay, versus 5.3% expected. But the reason for that industrial production to be beat is not such a good reason. It was basically to try to front run a lot of the tariffs that were coming in. Do you remember the tariffs that were coming in a few months ago between US and China? Well, obviously, companies aren't stupid. So they're thinking, well, if I'm going to have a 25% tariff on the product I order from China, I better order extra of the product now so I avoid the tariff when it's put into place. And there was a lot of companies and businesses have been stockpiling, front loading their orders, and that's why industrial production was so high. An interesting figure is the retail sales that came out of China. If you notice that it was 8.2% versus 8.1% expected. So there had been concern about slowdown in the Chinese consumer, particularly it was Apple earnings that led to some strong Japanese yen strength a few weeks ago, and the concern was that the fall in Apple sales was a reflection of a slowdown for Chinese consumers. I have to say, one of the things I'm sort of slightly concerned about is the thing with the iPhone is that Huawei is becoming more of a competitor for iPhone, and you just got to look at the headsets that Huawei produce. They are technically competitive with Apple now. You get some very good Huawei phones, and I think they've got a 20% share of the Chinese market, and they've been making gains on Apple iPhones, so that is always an interesting thing. Okay, coming to the next situation, we have the currencies for the day. So coming into Monday, we've got strong New Zealand dollar and Canadian dollar at the start of the session, and weak Canadian dollar, New Zealand dollar, a strong US dollar, and we had strong euro and Japanese yen. And the New Zealand dollar was quite weak in the Asian session as well. I couldn't see any particular reason for that, though I know there's some CPI data out of New Zealand later on this week. We'll come on to that later. Now, the key focus on Monday was the Chinese data, and also we had some PPI data out of Germany. Now, that was a miss, minus 0.4%, and that's been weighing on the euro. because there's been a slowdown in Eurozone growth. Draghi's meeting on Thursday, and many people are thinking that there's less chance of a rate hike now because Europe has slowed down so much. And this is just confirming that slowing down narrative. So expect the euro to be weighed on this negative sentiment that's going into Draghi speaking on Thursday. I mean, one trade setup that I was looking at was the euro Canadian dollar short. And that was comparing, the two different things, with oil being bid, with OPEC reaching agreement, with the US oil rigs down in their total numbers, and then you're also looking at euro weakness. I thought a euro CAD short makes sense going into Thursday. So that's one trade that I was looking at. Now we're coming to Tuesday, we've got the main event, and this is also the main event today in many ways, because what Theresa May is doing is she's releasing what's called her Plan B to Parliament, and she's releasing that this afternoon at 3:30 GMT time. Okay, so the pound is really in focus at this moment. So I'm just going to have a quick look at the pound and show you some of the risk levels that we have with the pound as it is now. Just zooming out, okay, what we see here, zooming out, is we see that's better, right? This is the daily chart, and we can see that price has hit the 200 exponential moving average on the daily chart 1, 2, nearly 3 times, 4 times, and sold off each time. This large tail pin bar here was the defeat of Theresa May when her Brexit plan was voted down in the UK Parliament. Price sold down and snapped back up. The reason price snapped back up so quickly is because market participants suddenly saw that with the way and the extent of Theresa May's loss, it meant that an extension of Britain's withdrawal from the EU suddenly became more likely. And in a strange twist of events, it meant Britain leaving the European Union without no deal suddenly became less likely. So there was strong buying sentiment. Now, in the big picture, the pound is really undervalued against the US dollar. And the reason the pound is being sold is on the uncertainty of Brexit. Now, if you think about it, this is obvious, isn't it? Many companies are thinking, we want to invest, 500 million pounds in our UK business, but we don't want to do it until we've got Brexit sorted. So companies, businesses, investors are all holding back until Brexit gets sorted. And this in turn is weighing on the pound, and the pound is weaker than it should be. And most analysts think that the pound, a fair value for the pound, will be closer up to 1.35, okay? So many analysts see that if Brexit was sorted tomorrow, that they could see the pound going up to 1.35. So, that is not too far off 1,000 points from the low when Theresa May's deal was left, and it could even be going up to 1.4. So there's a lot of upside on the pound. So looking here, how do you define and limit your risk? Now, going into Theresa May's parliamentary vote, there was a huge risk of volatility. That volatility is still here on the pound on headlines. So if you're trading the pound short term, what you have to be aware of, there could be a headline that suddenly comes out. It could be something like, EU's Michel Barnier says that he can easily put a sunset clause into the Northern Irish border problem. You're going to see the pound rocket up. Okay, because the market's trying to think at what point can we buy the pound and not have the risk of volatility. So we're getting quite close to that point now. We're still going to get headline volatility, but look, technically, we can see the technicals are working well to define our risk. So the 100 exponential moving average, 200 exponential moving average, we've hit the 100 exponential moving average. And going into Theresa May's announcement, what we see is this, if you wanted to go long into the announcement on Plan B, this is a sensible place to go long because, again, not trading advice, but I'm just saying this is the kind of situation you want to be looking at. Is if you thought, I want to do this, then you can put your stop underneath the par here. You've got the 50 exponential moving average, and you've got plenty of upside, so you can get at least 1.5 twice what you've risked on the upside, heading up towards 1.30. Again, not advice, but it's simply showing you the kind of situations you can be in. Again, you can see the 100 moving average, see 50 exponential moving average, 100 and 200 exponential moving average respected here, and there's plenty of upside to there. Again, on the 15-minute chart, again we see the 50 exponential moving average. It was sold off from here, sold off from there. It's now broken through and showing some support from here. So a very short-term trade, you know, is just at that area there. But this is not a great time to enter intraday trades because UK traders are heading for their lunch and US traders would be heading to their desk, except they're not because the day's a holiday for the US. So that's something to be aware of. And 3:30, it's important to be aware of the headline risk coming out of Theresa May. That's just giving that some context. So what things could happen? Well, you can still have the possibility of a no deal, but that's now down to only 10%, okay? Only 10% chance of a no deal. You've got a checkers deal returns. So what Theresa May is hoping is that she can reinvigorate her deal and get it accepted. I could see that happening with a sunset clause if the EU said they were happy to put a time limit to the Northern Irish border, say like 3, 4, 5 years. I think Norway said that they suggested it to the European Union, but then there's currently about a 10% chance of that happening. A better deal number one, so that is the idea of a renegotiated deal. The EU said they won't renegotiate a deal, but I think when you see that there's no way of Theresa May getting the deal through the UK Parliament, there's going to be some room for some type of negotiation, although not sure what that would look like. We also have a better deal number two. This is the idea of having a customs union similar to Norway, but a little bit extra. Now that's better for the hardline Brexiteers. So that's seen as a more likely a situation, a kind of renegotiated, reorganized deal, restructured. 30 to 40% chance seen on that. And then we have a second referendum, which is gone up to a 15 to 20% chance. And although Theresa May says she won't have a second referendum, and Labour doesn't want to necessarily have a second referendum, if there is an election that's forced, this could be a point that's that a party promises in order to get elected. So that is, a real chance. And if that did happen, that would be very positive for the pound. And the reason it'd be positive for the pound, because it would mean there's less likelihood of Britain leaving the European Union, and that would result in a strong rally in the pound. The general election, this is what the Labour Party wants to go for. This is why Jeremy Corbyn won't agree to talks with Theresa May. He wants an election. It gives him an opportunity to get into power. That's part of the reason. And finally, Brexit delayed. Now, this is the key thing. This is why the pound rallied. And the reason the pound rallied is because it suddenly became clear, and this is a greater than 60% chance of Article 50 being delayed. Now, Article 50 is the formal withdrawal of Britain from the European Union. It happens on the 29th of March, 2019. And there's not a lot of time left. So there's a lot of different options that are available to Britain, but time's running out. This is why the pound rallied. Now, I saw this on 11th of January. Okay, I suddenly realized, I've just put this post up here that I did in order to show you that I'm not making this up, but I put it here from the 11th of January, and it was a long post. But at the bottom of this long post, I put these three options at the bottom of this post that I wrote on the 11th of January, and I referred to it again on the 17th of January. But what I said is I suddenly saw that no matter what would happen, the pound was going to appreciate, because, as I said, I thought if May loses the vote, then that opens the door for Corbyn in a second referendum. The pound's going to appreciate. If May wins the vote, the pound's going to appreciate. If May postpones the vote, the pound's going to appreciate. So I thought it doesn't really matter what happens. The pound is going to rally on and around that vote time. Now, what I wasn't sure on was the timing. I wasn't exactly sure how do I get that timing, because obviously with the volatility risk, and I outlined it to a number of you guys before, that there are huge risks to volatility around these kind of events. So it wasn't just a question of jumping in, because I didn't want to have, you know, a 500, 1,000 point stop, which is the sort of stop you'd need to allow for the volatility. But what I did, I waited to the event, and this is how I managed it. And this is just again for your education. This was, let's have a look. Yeah, let's have a look. Yeah, this was it. So this was the May's Brexit defeat. Okay, so I watched it and I thought a lot of analysts were saying that the number of votes that May gets defeated by is going to result in a strong reaction to the pound. So I thought initially, yeah, that makes sense. Okay, a big vote loss. There's going to be an initial reaction. But I'd remembered, you know, actually, that whatever happens, I thought actually the pound's going to have to appreciate here. And sure enough, that's what happened. And this was on the 1 hour chart. You saw this huge reversal candle. And when I saw this, it was actually on the 15-minute chart that I saw a strong reversal. I thought, yeah, this is it. The pound's appreciating from here. This is what's happening. And I entered along here, and then I exited here right at the top. And you think, well, how did you pick that, Giles? How did you know it was going to go up to there? Well, it was very simple, because that was where the 200 exponential moving average was. Okay, so I could see the obvious target was the 200 exponential moving average, and I was talking to one of the guys. I was talking to Raj, who's just arrived. Hi, Raj, good to see you. And I was talking to him on a webinar that I was doing with Raj, and I was saying, look, you know, the obvious target for the pound was this 200 exponential moving average. Yeah, hi, Raj. I'm just talking about that time when we were doing the webinar together, and we're talking about the pound situation and saying that the 200 exponential moving average was the obvious target. And then since that time, price rallied up, touched the 200 exponential moving average. I looked at it, I waited at the time, and what I wanted to see was price going to break above, close above, and get above. I saw it, it made an attempt to go over, so that trend line there, touched it technically, that was the place, saw it, that's the time to get out, took my profit, and obviously that turned out to be the right decision. But we're now testing the 100 exponential moving average again, so that's where we currently are. If you look on the pound, and you can see here on the 4 hour chart, got some strong price action looking to the upside. You've got a rejection of the 100 exponential moving average. So this is the near-term place to limit and define your risk is there. Your short-term target is back up to the 200 exponential moving average. So there's a good risk-reward ratio on that kind of trade. Again, not trading advice, but just, you know, making it clear and helping people understand the way you want to try to put these stories together. It's all about stories. That's the lovely thing about trading. Understand the story. Define, limit your risk. Come along on Tuesdays, and I help to, you know, show you guys how to do that, how to put it together. And you know, May at 3:30 is talking today, so there's so much to talk about. Yeah, I've gone through that. We've gone through the currencies for today. I won't do this. I've done that with you. Just to point out here, this is the probability of a UK interest rate hike. So the probability of an interest rate hike in the 1st of August 2019 is up to 34.9%. So if you can see, look, the UK economy, once Brexit is sorted, is looking at hiking. So that's just to have it in mind. Brexit just consumes everything with the pound at the moment. But this is just to keep in your mind when the next interest rate hike is. It's around August when it's expected that you got a 34% of a hike going down into 39, nearly 40% by the end of the year, 19th of December. Eurozone, we've got Eurozone slowing down. Now, if you remember, Mario Draghi said that he was going to hike interest rates at the end of summer 2019. I just wanted to point out that the rate is currently 0.4. So the probability of a hike is 50% in December, and it's only sort of 25% in September 2019. So that's when Draghi said, but the market's seen the data and recognized actually the ECB is probably going to have to slow down. So that's just to show that the probabilities of interest rates are indicating a slowdown from the ECB. Let's quickly look at the calendar. I've hopefully helped to give you some context. Remember, all trading is about the fundamental analysis. It's about putting that together with the technical analysis, defining, limiting your risk, and understanding that underlying story to help you to make wise decisions. We've looked at the China's GDP. We see why that's relevant. We've also looked at the UK Brexit announcement from Theresa May, Plan B. We've seen why that's relevant. This is average earnings out of the UK tomorrow. Okay, it's important for the UK, but it's overshadowed by Brexit. But the average earnings are expected to be good again. Okay, so just bear that in mind, that there's good data expected for the pound. So if tomorrow the market is positively encouraged by Theresa May's Brexit plan and there's bullish sentiment in the pound, then buying into this event makes sense, because this is expected to be good data as well. Okay, so that's buying the rumor, selling the fact. I will be covering that on Tuesday, how to do that kind of trade, how to buy into events. That's one potential example. Another important data point out is the New Zealand inflation. Now that's very important, because it only comes out once a quarter, the inflation level. It's predicted to come out quite low at 0.0%. Okay, so there could be an increased call for a rate cut if that keeps falling. So you can see, okay, well, hang on, I can see now maybe why the New Zealand dollar has been sold. Remember, we saw it was a weak currency. It's because they're sort of people are selling into the event. Okay, that's selling the rumor and buying the fact. There you can see an example of that today in the markets. Important data point. If you can be around, watch it, and a significant deviation will have a movement for the New Zealand dollar. So that's one to watch and one to look at. Wednesday morning, we have the Japanese rate decision. Okay, now the Bank of Japan hasn't altered its monetary policy for years and years and years. But there is a risk that Governor Kuroda could announce lower forecasts for inflation given the global slowdown. So their forecast for inflation has been like 2% for years, and they don't get anywhere near it. So, you know, why don't they try and have a different a target? And there's suspicions that maybe there'll be a change. So that's something to be looking at. Trading the yen into Wednesday, be careful, because this has strong possibility of altering the direction of the market. Thursday, we have Australian jobs, and let's have a look. Yeah, so here we go. We've got the employment change and participation rate and unemployment rate. The unemployment rate rose to 5.1%, and that was a result of an increase in our participation rate of from that, and that's expected to remain unchanged. Again, potentially moving for the Australian dollar, one to look at. The main event on Thursday is the Eurozone interest rate decision. Here, Mario Draghi is going to be telling the market, we'll get a little bit more what he's thinking. And the European Central Bank ended its quantitative easing program at the end of 2018. Okay. So in other words, it's saying, oh, our economy is getting better. We end our QE program. We're going to start raising interest rates. But, you know, look, Italy has probably entered a recession. Germany has narrowly avoided a technical recession. France has been suffering from protests and the yellow vests. We've got Brexit. And don't forget that Brexit will weigh on the European Union economy. Okay, so it's not just one way. It's easy to think, oh, Brexit, that's good or bad for Britain. No, it will weigh on the European economy as well. So you put that all together, and then there's plenty of reasons for Draghi to indicate less inclination to raise interest rates. And if there's a less inclination to raise interest rates, the European currency will fall, the euro will drop. So expect negative sentiment on the euro going into this event. That's why I was selling euro Canadian dollar, because I'm expecting negative sentiment on the euro. Have a look at the euro today. I was reporting on this, and you can see, look, pound is just pushing up past those technicals levels into the 100 exponential moving. That's the next test for the pound. Get close, stay above there, and then we're looking further. Looking at the euro, just quickly look at this because it's worth it for you guys. That's interesting. It's there you go. You can tell I am long the pound at the moment, so that's why I was just pausing a moment to see what happened around that 100 exponential moving average. Now here's the euro, US dollar. We had that weak data point out of this morning from Germany, and this was I was looking at, I was reporting on this, and it was that 50 exponential moving average was tested and respected, rejected. There's a large option expiry level at 1.14 of 1.2 billion. That acts as a magnet or a detraction. So you put those two together, you can see price moved up, tested, rejected, and sold off down to this level here. So that's, and we're seeing some US dollar strength in the market as well. So going back to our PowerPoint. Yes, that was just saying that the cut of the Bank of Japan to cut CPI forecast. Those are the major events that we have coming out for this week. It's an exciting week. There's a lot to potentially move the market. I've gone through things quickly, but I hope that's helpful. You can always go through the webinar again and look at things in more detail. I've tried to pinpoint the most tangible and the most market moving events for you. I think the market's going to start getting some clarity in this week and next week. Remember, the US shutdown is still going on, entering its 5th week. Usually it doesn't affect the US economy very much, but this shutdown has gone on a long time. Lots of people aren't getting paid. There's indications of some people who are taking on second jobs because they're not getting paid for the job that they should be doing for the federal government. So there is going to be an effect on the US economy from now onwards. So expect that to be greater and greater voices weighing about that concern for the US economy. I hope that's been helpful for you. Don't forget, Tuesday, tomorrow, 1 o'clock to 2 o'clock, I'll be looking at how to put some of these fundamental and technical elements into practice. I've shown you a little bit today, giving you a little outline, a bit of understanding. Please do come again tomorrow on Tuesday. I'd like you to ask me questions. I like to help traders trade, just as other traders help me trade. I like to pass that on and to encourage other people, because trading is a skill that could be learnt like any other skill, and all you need is perseverance, persistence, someone to show you the correct information, and it's something that's achievable for anyone and everyone who really puts their mind to it. Thank you very much. I hope that's been helpful to you. It'd be helpful if you could just let me know in the question panel if that has been helpful for you, and I look forward to seeing you tomorrow on not 12:30 to 1, tomorrow at 1 to 2 GMT. Have a great time, everyone, and hope you have a good week, and hope to see you shortly. Thanks then, guys. Goodbye. Oh, that's good. Yeah, I'm glad that helped, Nadir. Thanks, Raj. Super.